That's after the great financial crisis, and here we are today with Rosa Roubini and Brunello Rosa, today partner in Rosa Roubini Associates, discussing the great financial crisis, the outcome of this crisis, and obviously how it all started. Welcome, Rosa Roubini. Thank you for being here. Just try to understand. I mean, you were called Mr. Doom for predicting this crisis, but actually you were absolutely right. How do you feel today?
Well, I usually say that I'm not Dr. Doom, I'm Dr. Realist. The important thing is not to be optimist or pessimist, but trying to independently understand how the world works and try to figure out whether things are going in the right direction or the wrong direction. So I got this nickname, but I'm usually a kind of a objective observer of what's happening, so you have to be really cautious and realistic.
Nadia, can we remember again how it all started? I mean, how, first of all, you managed to predict the crisis and how it all started and how it all developed?
Well, I would make the following observation, and I wrote a whole book after the global financial crisis titled Crisis Economics. And the broad observation is that while, of course, there are many differences between different financial crises, there are also some similarities. And I've done a long work also on financial crisis in emerging markets, and I had written a book about it a few years before. And the point is that while there are differences, financial crises have similar commonalities. You can have, first of all, an asset bubble. That asset bubble could be in internet stocks, could be in housing, could be in a new technology. You have the beginning of build-up of leverage as people borrow against rising asset prices. This leverage can be in the private sector, but also situation of risk where excessive deficits of the government lead to a build-up of public debt. There is a situation of complacency where things are going well and everybody becomes bubbly. Private sector becomes corporate, financial institution, households, regulator asleep at the wheel, and there is a feedback between the build-up of the credit bubble and the asset bubble. There is excessive leverage, excessive risk-taking, and at some point something cracks. Economists refer to it as the Minsky moment because Minsky was one of the few non-mainstream economists who saw the nature of financial crisis and wrote about them. And then you have unraveling from an asset and credit boom and bubble, then you go into an asset and credit bubble going into a bust and a crash. And what went up starts to go down, and there are lots of economic and financial consequences that lead to a crisis and a recession as well. So this is the broad framework. In the specific of the global financial crisis, of course, the beginning of it was a housing bubble in the United States, mostly for people who could not afford homes. That's why it was a subprime, with subprime mortgages being the center of a build-up of excessive leverage, but home prices were increasing and became a broader credit bubble that was not just in housing and in credit, but also in other parts of the economy. And of course, some of the international dimension of it are driven by forms of contagion through trade and financial link, but the reality was that there was also a housing bubble in other parts of the world. There was a housing bubble in Ireland, there was a housing bubble in Spain, there was a housing bubble in Iceland, there was a housing bubble in Dubai, and no wonder it was actually a housing bubble also in the United Kingdom. And no wonder that then when the bust occurred, while people concentrate on the US housing boom and bust, there was also a bust in all these other countries. So some of the contagion globally was not contagion, but that you had similar type of phenomenon of asset and credit bubble in many other parts of the world. And that's part of the element that became international. Of course, then there are specific elements to this one because we were in a period of time where maybe the Fed started to tighten too little too late, and that allowed asset bubbles to be fed. There was a period of time where there was a glut of global savings because of what China was doing in terms of its current account, and while the Fed was raising short-term interest rates, long-term interest rates were remaining not as high as before. This was the bond conundrum, why long rates are not going higher, so financial conditions were easy, regulators were asleep at the wheel, the Fed was not doing its job, both in terms of monetary policy and also dealing with asset bubble. And the other phenomenon of it that was specific was there was this process of securitization. You started with mortgages, you slice them and dice them into mortgage-backed securities and CDOs and CDOs of CDOs of CDOs. And in this securitization chain, everybody was making some money and charging fees. The banks, the mortgage originator, those who were appraising the loans, the rating agencies, the bond insurers, the investment bankers, and you were essentially transferring the credit risk down the line from mortgages to very complex instruments that were complex, were not seen before, mispriced, where nobody knew what the fundamental risk was it, and everybody in this securitization chain was making actually a cut and transfer the risk. And eventually had these instruments that look like monster with CDOs where the AAA tranches look like AAA, but they were not AAA because the underlying assets were actually subprime mortgages, were very risky. And therefore, that created also a sense of confusion, lack of transparency. And then when the panic occurred, of course, you don't know what's bad, what's good, who's solvent, who's insolvent. And that type of element of a panic is also an element that leads to more market reaction, the fire sale, and then the snowball down of the bust and the crash. So lots of different things are happening.
Yeah, so talking about this, it was like a domino effect. So how related was the crisis that emerged in Europe in 2009, in European countries in 2009? How strongly linked was this to the 2007 subprime crisis in the US?
Well, there were a bunch of different links. Some of it was that among the European countries that got in trouble, some of them had excesses that were in the private sector rather than the public sector. And excesses, as I pointed out, was that at least in several countries, namely Spain, Ireland, and Iceland, you had a major housing bubble and a similar kind of excesses of excessive credit and leverage. So they went bust, and the trigger for their crisis was the excesses of the private sector. The other side of it was that a whole bunch of financial institutions, even in the core of Europe, French, Italian, German, had exposure to these subprime and these toxic instruments, and therefore you had the transmission of the shocks to them through this financial channel. And then you had a whole bunch of other European countries that had loose fiscal policy and running very large budget deficits, sometimes even hiding the size of their deficits, and they had high deficit and debt. You know, Greece is the most extreme example, but of course there were other countries that also had fiscal imbalances, like Portugal, like Italy. Eventually we figure out also other countries like Cyprus and so on. And therefore, in their case, maybe the trigger was initially that the recession ballooned deficits and debts in a way that implied potentially insolvency. And in this, throughout Europe and the periphery of Europe also, you had that a lot of the public debt was held by the banks. So maybe the Spanish and the Irish banks went belly up because they had a lot of bad mortgages and exposure to housing. But the Greek banks had exposure to the Greek public debt. And when that became unsustainable, then you entered in a doom loop between the sovereign and the banks, where initially the sovereign has a lot of deficit and debt, and then the banks have exposure to the sovereign, and once the banks go into trouble, the sovereign is supposed to bail them out, but the trigger for the problems of the banks is the problem of the sovereign. If the sovereigns try to bail them out, then that makes the sovereign even more insolvent. So you enter in this doom loop between the private and the public sector. And of course, when you also have a private sector problem in the first place, like in Ireland or Iceland or Spain, when then the bust occurs, you have to do a fiscal stimulus, the deficit goes higher, you have to backstop the banks, and that implies you're socializing the private losses, that builds up public debt, and that increase in public debt then again is held by the private sector, and that creates another feedback back to the real economy and the financial system. So essentially, whether the problems start in the public sector or the private sector, problems of the private sector become public sector, and problems that the public sector, given the holding by the private sector of the public debt, become problem of the private sector. And then they feed on each other in a way that becomes actually very disruptive. That's part of the story for Europe.
Looking back at these past 10 years, is the world today a safer place or not? Is the financial system more secure? Is it safer? Is it better?
Well, I would say that, in some sense, you could be optimistic by saying that there is still global growth, there is still globalization, there is still a huge amount of technological innovation, and this technological innovation is going to actually increase productivity and lead to a better world. Billions of people actually, especially emerging markets, have gone from starving to poverty to now becoming middle class. So, globalization, technology, economic reform have been good for 2.5 billion Chinyans and other billions of people in emerging markets, whether it's in Asia or Latin America and so on. So there's an optimistic view that actually technology and other things are going to improve the world. But there is also a sense that these things are essentially implying these trends that some people are more successful and some people are less successful. Trade and globalization, migration benefit some and leaves behind other people. And I would say in the future, actually, in my view, a technological innovation may be more disruptive than trade and migration. And I'll give you just one example. Suppose that Donald Trump was successful and he could just build a wall so nobody can get in the United States. And suppose they impose a 50, 100% tariff, so there is no more trade balance and you just produce everything at home. You think that growth and jobs are safe? No, because technological innovation is going to disrupt jobs. I mean, for example, it's only a matter of time, I don't know, it's 5, 10, 15, 20 years where autonomous cars and trucks that are driverless are going to be essentially replacing traditional cars. Now, in 48 out of 50 states in the US, the number one profession is truck driving, about 5 million people. Lots of poor people now are Uber drivers or driver of all these services. It's only a matter of time when all these jobs are going to be gone. And these jobs have nothing to do with trade or migration. They're all domestic jobs. In the service section, they're non-traded. But all these jobs are going to be gone even if there's a wall and even there is full protection. So sometimes I fear that we're fighting the wars of the past. We're worrying about trade, about migration, about globalization, but technology in the future could be disrupting jobs much more severely, and incomes and wages and labor compared to capital. So we live in a world in which technological innovation is increasingly capital intensive, skill buys and labor saving. So if you own financial capital or real capital, you do well. If you're in the top 20, 30% of distribution of skill, education, human capital, you'll do fine and technology helps you. But if you are a blue collar, but increasingly even a white collar, because many of these white collar jobs are subject to technological changes and disruption. And even if you are not just a low skill worker, but even a medium skill worker, many of these jobs are going to be subject to robotics, automation, AI, and you name it, and they're going to be disrupted. And this is the bigger challenge we're going to be facing in the medium long term. And of course, in the short term, we are still in a world with too much private and public debt, with too much financial excesses, with mediocre still economic growth, with, of course, rising geopolitical risk and domestic populism and so on. So many things can go wrong in the short run, but actually we need also to think about how we're going to give jobs and income given the changes in technology over the medium and long term. And that's going to be an even bigger challenge.
Yeah, so as you said, this is definitely one of the biggest challenges of today's world. But do you think there is the possibility that another great financial crisis can emerge from what you just described?
Well, eventually there will be another US and global recession, even if it's not mechanical. It doesn't have to happen every 10 years. It depends on which kind of shocks and mistakes occur. And if and when that recession were to occur, we live in a world in which today both private and public debts are on average higher in advanced economies and in emerging markets than they were before the global financial crisis. Yeah, there has been some deleveraging in some part of the system, some of the banks are less leveraged than before, but corporates in the US are more leveraged. But the reality is that in spite of higher levels of debts, what made the system sustainable was that debt servicing ratio have been now low. They've been low because on the short end, you have zero policy rates, if not negative. And on the long end, thanks to quantitative easing and other policies, also long-term interest has been very low. So even if debts are high, if the interest you pay short or long is low, you can sustain these things. Now, what could happen in the future is that if gradually, inflation is going to rise, then central bank and the Fed have to normalize. So are those debt ratios sustainable when interest rates are higher? And some are very highly leveraged parts of the system. And once you get a shock that leads then to a recession, incomes are falling, so debt to income ratio go higher, and if at the same time interest rates are higher or the credit spreads you have to pay because you have high debt become higher, then that's where you could have another distress. And during the next financial crisis, the question mark is, do we have the policy bullets to respond to it? Last time around, we had some fiscal space and we had very aggressive monetary space, and we were also willing and able, and having also the financial ability to backstop the private sector and the financial system. Next time around, the fiscal space is going to be limited only to some countries, but not others. These unconventional tools may be used, but there are constraints to them. And also politically, the ability to bail out banks, corporates, and so on may not be there because the populist backlash says don't bail them out. And leaving aside the political ability, even the ability financially, if you have a government that are highly indebted, they might be so distressed that there might be risk of default themselves, let alone taking more debt to backstop banks, financial institutions, and corporates. So the risk is that, if the shock is big enough, then the policy kit is we have used most, if not all, of the bullets, and therefore ability to backstop the system is going to be more constrained than the past, and therefore the recession, the financial shocks could become more severe and more intense. And therefore then the political backlash may be even more severe. That's a risk.
And Nouriel, one last question for you. What was your experience of the collapse of the Lehman Brothers? What are your memories of that day, of that moment?
Well, I was following the financial crisis, in real time, day by day, and writing about it. And in some sense, I remember that day and watching TV and the collapse of Lehman and the panic on financial market. But in many ways, one, I saw it coming. And I think that the interpretation is because we let Lehman collapse, then that caused the global financial crisis to become more severe. So letting Lehman collapse was the cause of the global financial crisis. But to me, is a bit of a reverse causality. We reached Lehman after you had the subprime bust, the housing bust, the banks had hundreds of billions of losses, and Bear Stearns went down, and then the GSEs, Fannie and Freddie Mac, were bust, AIG was bust. So it's not as if Lehman was the cause of what happened, but lots of other stuff had happened, and then Lehman was the peak of that crisis. So it was a critical moment in some ways, but a lot of the economic financial damage had already done before, and for the collapse of Lehman became a catalyst for even a worsening and globalization of the shock. But thinking of it only as Lehman, and if only Lehman had been bailed out, everything would have been fine. No, because we were already in the middle of a financial and economic crisis for a year and a half before Lehman occurred. So it was an important moment everybody remembers. I remember that day, but in some sense was not the cause, but the consequence of everything that happened before.
It's a bit like the twin towers of the great financial crisis, in a way, the very peak of the
Yes.
financial crisis. Rosa Roubini, thank you so much for being with us. Thank you.
Great being with you today.
Thank you. And now let's also ask Brunello Rosa about this. Actually, Brunello, is it true that monetary policy is just another way of conducting foreign policy in disguise?
Yeah, I mean, at some point during the financial crisis, it became very important to have the currency as weak as possible, because that was a way of reflating the economy. Inflation collapsed. A number of countries went even into deflation territory. So of course having a weak currency helped. Now, given the various arrangements at the international level, it was forbidden, so to speak, to conduct direct FX interventions just to weaken the currency on purpose, but countries were given the option of using monetary policy for their independent reasons to reflate their economy. And of course, if there were to be unintended consequences, so to speak, of weakening the currency, that would be accepted. So that's the reason why a number of countries start increasing the balance sheet of the central banks. Then central banks introduce other tools such as negative policy rates, negative deposit rate in the European case, the European Central Bank, and so on. And other central banks went even more negative than the ECB, and that led effectively to currency depreciation. Somebody call it, FX wars by proxy of using central banks' balance sheet.
What's your take on this, Nurio?
I would agree with what Brunello just said. I would just only add the following point. At some point there was a risk of currency wars, but in some sense not everybody can have a weaker currency. If my currency is weaker, somebody else has to be stronger. If my trade balance has to be better to boost growth, somebody else's trade balance has to be worse. The sum of all trade balances in the world is equal to zero. We don't trade with the moon or other planets. So it became a bit of a zero-sum games in currencies and a zero-sum games in trade balances, and it was a source of tension and concerns that eventually currency wars might also lead to trade wars. Now, of course, maybe if everybody was trying to follow unconventional policies, that would boost economic activity in spite of the currency effect being a wash. And in that sense, unconventional policies were positive regardless of their currency impact, but there was certainly a source of trade tensions and currency tensions too.
Brunello, do you think that liberal democracies are now equipped to counter the rise of populist parties?
Liberal democracies have plenty of instruments to deal with the phenomena we are seeing at the moment. The question is whether they are willing to use them or not. Income redistribution would be one of them, from the richer to the poorer. That would help part of the problem, not everything, because that's a very complex situation that has led to the rise of populist parties, including migrations, the sense of loss on sovereignty, and so on and so forth. But the fact that the loss of people felt kind of worse off because of globalization, because of trade, because of technological advancement, and so on and so forth, had led to the rise of these populist parties. Once you solved the economic problem, you have solved at least a great part of the issue. Now, of course, other things then need to be implemented in terms of a better distribution of sovereignty between local level, state level, supranational level. This takes a lot of time to be arranged in an efficient manner, but you need to start somewhere. At the level of European Union, at Eurozone, the debate is whether it will ever become a transfer union, where some of the implicit transfers from the periphery to the core are eventually reversed into explicit transfers from the core to the periphery. This is a debate that's been going on for a very long time. We never reached a point in which there's a breakthrough. And the question is whether the rise of these populist parties is effectively a wake-up call for people in the core, and understand that unless they solve this problem, the situation is not going to get better.
So do you think sovereign bonds could be a safe place, or there is a bubble in there?
Yeah, I mean, the price of bonds have increased massively since interest rates were cut so much by central banks in order to save the economies from the effects of the global financial crisis and also to bring inflation back towards their target. That has exacerbated a long-term historical secular, somebody would say, trend in yields that have been a downward trend for decades, from the late 70s, beginning of the 80s. And so a secular trend has been somehow made even faster by the actions of central banks. Now, does it mean that bonds are in a bubble territory and that this trend will reverse itself anytime soon? Well, not necessarily. The rate increases implemented by some central banks, in particular by the Fed, might of course put the valuations of those bonds under some stress. But think about, first of all, central banks are not going to increase rates to the level they used to in the past. Secondly, by the time interest rates will be high enough, say, to control for the rise of inflation, we might be again in a situation in which the central bank might need to start thinking, or even start not just thinking to ease, but start in fact easing. At that point, the valuation of those bonds will start increasing again. So if the next financial crisis were to occur, it's more likely than not that sovereign bonds will still be looked as one of the safest places where to go, especially those issued by the countries that have a reserve currency, such as the US, but potentially also Germany, Japan, and to a lesser extent perhaps the UK.
So will the world economy be as affected as it was 10 years ago?
Yes, I mean, if a new financial crisis were to emerge, it's more likely than not that the consequences on the global economy will be at least as severe as they were last time. Also because if our reasoning is correct, the next financial crisis might be perhaps even an order of magnitude larger and more severe than the previous one. As we said, history has told us that one financial crisis has been followed by one of greater dimension later on. That means that the economic impact is going to be at least as large on GDP, on inflation, on employment and unemployment, and on financial assets. That means that the cure to the next financial crisis is going to be at least as strong as it was last time in terms of using policy rates aggressively, of course in terms of easing, using quantitative easing, using credit easing, using forward guidance, and every other instrument that has been experimented in these financial crises to cure it.
And Brunello, do you think that Brexit could also be a proxy cause for the next great financial crisis?
I don't think Brexit per se could be a cause of the financial crisis because maybe the European Union is resilient enough to the exit of one of its member countries that that doesn't trigger per se a financial crisis, not even potentially an economic crisis or a recession, so to speak. But there might be situations that develop as a result of Brexit that could cause damage, and who knows, maybe potentially a crisis. Maybe not a large one, maybe not global, not systemic one, but might be quite a severe one, at least in Europe. We know that the Brexit arrangements that will follow the negotiations between Great Britain and the EU will most likely not include passporting to financial institutions. So quite a few of them would have to move to continental Europe. And not just banks, but also asset managers, hedge funds, pension funds, the central counterparties. So all the plumbing of the financial system might be moved to continental Europe. There are a number of contracts, especially in the derivative space, that have been written and are under UK law, in institutions that were based in the UK, and so on and so forth, that might also need to be moved or rewritten and so on. As part of this reorganization of the system, something can go wrong, and quite badly so if it's not well managed. And this is when disruption might happen, and maybe a disruption plus a policy mistake plus countries start screaming at each other because they start the blame game. And when you start having this kind of complex dynamic, you can rule out then you start having severe financial effects that amount to potential crisis, banking crisis to begin with, and then potentially extended to other sectors of the financial system.
Brunello, thank you so much. Thank you.
Thank you.